Voltaire, do I need to hit share screen, yeah?
Yeah, not yet. Let me make a quick intro. Welcome everyone. It's 6:30 p.m. on a Thursday. It's the last day of March, the 31st. And we're talking taxes, and I'm super excited for some reason, right? And I think the reason why is the more real estate that I accumulate, the more angles I'm trying to figure out. Am I doing things right? Am I missing something? And I just came from an event, and the event had maybe about 30 investors in there, right? And they invest in anything from real estate to real estate notes. And everyone in there was, what's the term, Jesse, that they call not a certified investor, but accredited investor.
Yeah.
So basically everyone in that room was a millionaire, is a millionaire on paper, right? That's how you get accredited. You have to have $1 million worth of assets. And the common theme in that room was everyone was talking real estate, right? They own real estate. Some guys aren't buying real estate right now. Others are still buying real estate, but everyone has real estate. I had a conversation with a gentleman who says he lives in Europe part-time, and he's an older gentleman. And he says, yeah, I live off my rents. And I said, oh, wow, that's awesome. How many doors do you have? And he says, well, I have 13 doors, and most of them are single family homes. And they're all here in San Diego, except for one that's in Alabama. So he says he lives off that. That's where all his income comes from, is his real estate, right? So that's the whole, so that was kind of inspiring to hear someone like him saying that he's able to retire and live part-time in Europe and part-time here and not have to work anymore. And there was another person today who said, hey, I make really good income, but I get to choose when I take the income. And he's working on a project, and he says he's going to get paid, a six-figure sum. And he says, but I'm not taking any income right now. And I go, why aren't you going to take any income? He goes, well, because I'm waiting to own this building. And once I own the building, then I'm going to offset it with my depreciation. And then that way I won't have to pay taxes. Therefore, I'm making more money. And I was like, oh, wow, that's cool, because we're going to be talking about that tonight. So it really excites me to be here tonight, especially after today, when I had several meetings and several conversations, shook hands with a bunch of accredited investors, a bunch of millionaires, and a lot of people who own real estate. So some of you guys I know, some of you guys I don't know. And before I introduce Jesse, I'm just gonna just introduce myself. That way you guys kind of get an idea of, who you guys are listening to. So I'm Voltaire Lepe, been born and raised here in San Diego. I started my real estate career 20 years ago, 2002. So this is my 28th year. I think I need a cake or something, Vanessa. I don't know. You guys haven't mentioned it there. I don't know if you're going to surprise me one day. I'm just going to show up. There's going to be a cake. I'm a full-time real estate broker and commercial and residential property manager. And I manage 16 sales associates here in the office. I've helped hundreds of families throughout the year, and we've taught financial literacy to a lot of kids and adults, ages 7 years old to 60 years old. And I've given over $100,000 to local charities at the age of 32. In 2016, I became a millionaire, and I reached retired level. So my net worth, I have enough net worth and cash flow in order to just kind of walk away from the game, but I'm not. And I did my first wholesale deal in 2005, made a $35,000 profit. And I have over 30 tenants currently paying me rent. The biggest deal I've ever done is 11.1 million. The smallest deal is a piece of land, $50,000. So that's a little bit about me and my experience here. And I'm looking to continue to grow. I'm continually buying real estate still in this market. Now, Jesse Lipscomb, he's here with us today. He's the guy that helps me kind of figure all this out, right? So I just dump a lot of stuff on him and say, hey, look, here's a bunch of real estate. Here's a bunch of stuff that I got, figure out ways to save me money. And of course, every dollar saved is a dollar earned. So Jesse has a cool background just because he's been doing this for a long time. And even before he started tax planning and accounting, he was doing investments, right? So he was
Yeah.
guiding people with their investments, financial advising. And Jesse, I know that's like a super weak introduction, but do you have a resume or something that you want to share with us about yourself? That way everyone knows, a little bit about you.
Yeah, man. Easy. My background's pretty easy. I am both an enrolled agent of the IRS, licensed by the man, and an SEC or an investment advisor with an SEC registered firm. What kind of my deal is I specialize in tax return-based financial planning, and since that doesn't, like, if I told that to the normal person, they're like, well, what's that, right? I've just simplified it. Like, look, I help real estate agents and real estate investors take control of their money, pay less money in taxes. Just that simple, right? I believe that the key to becoming wealthy is understanding your taxes. I mean, it's literally, my business is called Roadmap Tax, and I believe your tax return is your roadmap to figuring out ways to win. It's like your playbook, right? And so it's interesting. I'm neither really conservative nor ultra aggressive as a tax professional. I really believe that strategy and the truth will set you free, right? So I had a guy make $500,000 in commissions a couple years ago, and I said, okay, well, you're going to owe $200,000 in taxes, but if you put $200,000 in your own retirement plan, it'll save you $100,000. What do you want to do? Well, I want to do that. Okay, let's do it. Right? So it's just like understanding the numbers. I do a lot of tax bracket planning. And that's just understanding where you're going to fall in your bracket. Like, are you in the 22%, 32%, whatever? And background-wise, I'm a West Point grad, class '98. I got hurt, got out of the military, got into financial planning, and I pretty much use those skills of planning, organizing, and leading to help people pay less money in taxes.
Cool. Yeah. Thanks for
Yeah.
the intro. And how long you been doing this?
21 years. I got
21 years.
first license in March of '01.
Did you get a cake?
Got nothing.
Teardrop. All right. I'll get you a cake, Jesse. No biggie.
Appreciate it. I'll re-gift it to you.
All right, cool, man. Thank you.
But so yeah, listen. My deal is most of the concepts I talk about in a given day are hard. Like they're brain damaging. But what we can do collectively is, if you guys, whether you're I don't know, texting or messaging or raising your hand or just talking during this, if you have any questions about what we're going to cover, I think everybody will get a little bit more out of it. The first two parts of the presentation are how to become a real estate investor, either through your primary or through getting your first rental. And then what do you do? The history of every real estate investor, you have a time of accumulation and a time of divestiture. Eventually, you're either going to give it to your kids or you're just sick and tired of having it. So we'll show you ways to take control of your taxes that way. So let's talk about buying versus renting. First, in 2018, the tax code changed a lot. And part of that is there's now a new standard deduction. It's about $12,500 per person or $25,000 married. And when I say about, the bogey changes every year, but like here in my office, you come by, even if it's in the Zoom, I'm constantly referencing these tables because look, standard deduction is $12,950 single, $25,900 married. What does that mean? That means that just showing up to the party, if you're married, the first $25,000 of your income doesn't count. It also means that if you buy a house today as your primary residence, unfortunately, from a tax perspective, it's not going to help you as much as you want it to. It's going to help you, but let's explain. Let's get some real numbers. Voltaire, married couple, what do they earn on average?
Right now,
Married couple, San Diego.
yeah, we're seeing about 130,000. You know, we're seeing a lot of that. Yeah.
So we're right here. We're right here in the 22% tax bracket. Okay. For easy math, we're going to call it 8% California. California scales up, but after about 50 grand, you hit 9%. But let's just call it 8, just so we have easy math here. Yeah. But check it out. We got somebody making $130,000. Okay. 130 grand. You're going to be able to write off $25,000, $25,900 is that standard deduction. Okay. So really, you're only going to pay taxes on, what is that, 104, 100? Okay. Does that make sense? That's your standard deduction. Now, if we look at the Schedule A part of the tax return, Schedule A is what you itemize with, okay? And there's really only 4 sections. You've got medical, you've got state and local taxes, mortgage interest, and then you've got charity, okay? State and local taxes are now capped at deductibility of $10,000, okay? If you buy a $750,000 house in California, you're going to pay $9,300 on average in real estate taxes regardless. So if you're a homeowner, hitting that $10,000 limit, you get there pretty quick, okay? Voltaire, what are the average houses right now?
You really want to know? We're, I don't even know if I believe this stat. What is that, Cynthia?
Don't answer that question.
I know. So
Right.
it's good if you're a homeowner, but it's $1 million right now. As of January, the average sold price in January in San Diego, $1,002,000. So $1 million.
You know what's horrible about that?
If you're a renter, it's horrible. If you're
Right.
a property owner, I mean, you're living life.
Well, as a Schedule A homeowner, now what's a Schedule A homeowner? It's your primary residence, okay? What's horrible about that is that the amount of interest that you can write off is capped at $750,000. So you buy this, let's just go easy, right? Colonel Bevan's on the call, so she gets, zero down VA. He's financing $1 million. Let's say it's at what, 4%, 5% interest, okay? Let's look what happens here. $1 million, 5% interest on a 30-year note, okay? Payments is $53.68, and in a year, this is just an interest calculator, right? So we're going to go 12 months. The total interest in that year would be $49,664. Okay, so $1 million, 5% interest. The amount of interest that's paid, $49,665. The problem is, this is what the lender is going to report on IRS Form 1098. However, the IRS says, wait a minute, you can't write off the mortgage on $1 million. You're capped at $750,000. Well, $750,000, 75% of $1 million. So that means your favorite tax person is going to have to take that and give you 75% of that. And so now you're able to write off $37,248, $250, whatever, in interest on that $1 million home. Charity,
Got it. So real quick,
IRS
now that 37,000, by the way, Jesse, does that go on the left-hand side under the 130 that you put in there that they make? And then is that
Yeah,
how
I'm
you
gonna
deduct it?
Yeah. So the 25.9, that's your
Standard married deduction
right?
for married people.
And let's just do some rounding here. We got 37,250 for the interest. Let's say 750 for charity. I want to make some easy numbers here. Okay, so 37,250 and 750 plus 10 grand. Okay? So now you're able to itemize $48,000.
What is
technically pardon me?
what is charity?
Charity is like your church, your giving to a private nonprofit,
A
charity.
school or something like that.
Yeah.
So
Oh, okay.
whatever you
No, like,
decide to give, whatever you decide to give
Donation.
that donation, in 1 year.
Oh, okay.
Yeah.
Yeah.
So Voltaire's right when he says, how does it look on your return? You would write that off, the 48,000, in lieu of the 25 or 26,000, right? Well,
Got it. So it's
let's
only one
look
or
at
the
it-
other. Is that what you're saying? You
Yeah.
can't take both.
And,
Got it.
Well, and I'm also saying that there's a different way of doing the math on here. Check
Mm.
this out. What you really ought to do, you ought to go, okay, well, $48,000, right? Okay. I'm already getting 25.9. So I'm going into debt $1 million, and this is not a negative way of looking at it. This is I'm just telling you, this is the way you ought to look at it. So you got $22,000 more deductions than you would have, but you're only in the 22% tax bracket. So it's only going to save you $4,800 in taxes, which is about $400 a month. Okay. Now we'll also save you some state taxes, and so if we say, another 8%, so maybe another 2,000. Let's just say $2,000 of California taxes, right? All in, it's saving you $68.62.
So
Okay,
it's saving
which is
you.
what-
So being a homeowner and having like $1 million property, let's say, will save you 68.62 a year in tax savings
Mhm.
compared to if you're a renter, then you don't
Renting.
get that 68.62.
That's exactly right. So and then this is where my personal belief system in buying real estate will stem from. Don't buy the property because of the tax deduction. Let the tax deduction be a blessing, but the why behind the what, to me, is twofold. And these are old-timey reasons, but it's number one, pride of ownership. Hey man, it's your house, right? You're not going to have your rent increase every year, right? It's yours.
Well, it's almost like I don't know if whoever has my newsletter read my newsletter where I compared gas prices, right? They're expensive right now, $5, $6 a gallon. And if somebody said, hey, Voltaire, if you had the opportunity right now, would you lock in gas prices at $6 a gallon for the next 30 years? I would say yes, even though I know it's probably going to come back down. It's probably going to come back to like $4 a gallon, hopefully $3 or whatever. But eventually 15, 20 years from now, it's going to be above $6 a gallon. So this is, a reason why you're just mentioning, rent increase. If you buy a house, you could just lock in the mortgage for the next 30 years, no rent increase.
It's just like this, if you're renting a place and you don't like the kitchen and you renovate the kitchen, you just did the owner of the property a service. It's not yours. You make the backyard a veritable paradise. You've just done the owner a service. It's not yours. So the fact of the matter that buying the house will save you some money in taxes, that's pretty cool. But if we go back to this, let's just go in. I heard an ad in the radio that the average mortgage is like 10 years. It's a 30-year mortgage, but people have for 10 years. So that's 120 months. Think about this. In 120 months, you've been paying that same $5,300, right? But now your balance on your mortgage is $813 instead of $1 million. That's almost $200,000 of equity that you built regardless of the market. So if the property itself starts off here at $1 million, okay, the rule of 72 says whatever your interest rate is, that'll give you the number of years to double your money. So if San Diego real estate over the next decade averages 7.2%, then in 10 years, rule 72, it'd be worth $1 million, or $2 million, excuse me. Okay? At the same time, as you're paying down that property, right? And this isn't making extra payments, it's just paying it down. You've now paid it down to $800,000. So from an equity standpoint, you now have $1.2 million that you wouldn't have had just because.
Yeah, I like the way
Right?
you broke that down. So that's after 10 years,
Right?
rule of 72, which you guys use for investments, right? For financial planning. You're saying at $1 million property is going to be worth 2 million. And then you would have paid down with your monthly mortgage payments. You would have paid it down to about 800,000. So you would have $1.2 million in equity.
Yeah. And I have heard that, historically, real estate appreciates at 5%. So if we do the same thing, 5 into 72 is 14, 15 years, right? Well, I think it's going to even be more impactful because here you have your same $1 million house, and now we go out 15 years. 15 years, it's again, rule 72, it's now worth $2 million. What about your mortgage, which is going to be substantially less? Now we're going to go down to 180 months, and now we're going to owe 678, right? So call it 675 for easy math, right? So now we've paid that down to almost half, and now you've got, God, what is that? 1.325 in equity, and you just lived, like you just literally lived somewhere.
Right,
you know what I mean?
Too much, yeah.
And it's yours, right? So I think those are the big reasons. Oh, and by the way, if on average you saved $6,000 a year in taxes over those 15 years, let's say even $5,000 a year in taxes, 15 years, I don't think anybody listening right now is going to be particularly angry that you saved $75,000 in taxes.
Right. Over that
Right.
time that you're a homeowner. Now, the other thing too is, I know we were talking about the tax savings and with your primary mortgage, right? Because we're all talking about the
Yeah.
home you live in. We're not talking about investments yet. We'll get there.
Right.
But if it's 6,000 you're saving on average on a $1 million property,
Yeah.
or a $750,000 home, right? Same thing. You're
Yeah.
saving $6,000. That's $500 a month. So if your payments, in your example, is a payment was $5,300, you just subtract 500, so your real payment is $4,800, right? On that $1 million home that we are just talking about. So that's another way to kind of look at it. So there's it's weird, right, Jesse? Because you're explaining to us with these cool graphics, like Bevan said, in the comment, and so we're catching things that before, as homeowners, we've never caught before, and now with the $500 savings a month because of the tax benefit of owning your primary home. Now we're saying, well, I'm not really paying $5,300. I'm paying $4,800, right? So
it's funny, Voltaire. That was the old way we used to do. I even built a spreadsheet about 15 years ago in doing that comparison because it was really impactful. It's just that ever since 2018, when they got rid of the they changed the standard deduction, they got rid of your personal exemptions, it hasn't been that impactful since. You know what I'm saying?
Yeah.
It's I'm going to just go back to it because I really believe this to be true. Look, being able to call something yours, this is something that I really think only owning your own business and owning your own property, those are I mean, I guess you can be proud of your car, but your car's going down in value,
Hey,
man. And I
hey,
know,
if you're 18, yeah, go for it. But if you're
right?
an adult, come
But
on.
I mean, come on, man. How many of y'all have spouses that want to remodel the kitchen or the bathroom or the garage or, change up the landscaping? And you know what? I mean, at the end of the day, you're spending money, which is beautifying your property, but you're doing it because it's yours, because you're proud. And I think that's the right kind of pride that we need in this country right now. Be proud of where you're from. Make your neighborhood beautiful. And the fact of the matter that we live in a geographic oddity. Like what? Like, come on, guys. We're in San Diego, California. We have the most interesting geography in the world over here. Guess what? We can't go west and we can't go south, right? Anywhere past like Alpine, the geography out here, they're not building out there. And we got a Marine base up here. So you got to jump over to Temecula. Like we are an island at the end of the country, right? So long term, if we think about it, yeah, gas might go back down, but a decade from now, 20 years from now, 30 years from now, to think that San Diego real estate isn't going to be worth more later than it is today, and this isn't coming from like a real estate economist's viewpoint. I'm just a regular guy thinking, wait a minute, we are always going to have a shortage of land for the people that are here. Just a matter of time.
Yeah, that.
If you can get in, you're going to make money. I'm just talking about your primary residence.
Yeah, you're just like a regular guy, like you said, but you're a regular guy using your brain. It's crazy because I mentioned earlier in the call, for those of you guys that weren't there or at the beginning of the call, I just came back from an event where there's 30 something. What's the name again? The term, Jesse?
Oh, accredited
investors. That means you have to have $1 million in order to invest. And all of us, well, I know I do, and several others in the room, we invest with this company. We invest in real estate notes, right? That's a different class, different topic.
Yeah.
But anyways, all these guys that I was having conversations with, they're just regular guys. They just happen to have bought, a home. And a lot of these guys were buying like in the 80s, 90s.
Mm-hmm.
And a lot of them are still buying today, but they just bought one home and then they bought another home and another home. And next thing you know, they're in this room, a bunch of multimillionaires, just enjoying life. One guy, like I said, he lives part-time in Europe. I talked to another guy who said, yeah, I just came back from Thailand, and and then the next trip I'm going to French Riviera for a week. And I mean, these guys, they're not geniuses either. They're just regular dudes that just happen to have bought real estate. So I like that.
Yeah, and it's like I love reading books on success, and one of those books, the Millionaire Next Door. Now, I will tell you this: I have only ever read this book on audiobook, because if you're trying to memorize everything they say, it's hard, man, because it's a study. It's all statistics. 75% of the millionaires do this. Right? But if you can listen to it and understand it for what it is, the average American millionaire is not who we think they are. They're not a professional athlete. They're not a entertainer. They're regular people, typically in their early 50s, who have had the same house in the same neighborhood, the same career, the same spouse for 20 to 30 years. And in that time period, they've been able to, I hate saying the word, the phrase live below their means, but rather say they've been able to pay themselves first, right? They've been able to make accumulating wealth a priority, okay? And It gets me excited when I'm talking to guys. Like, hey, look, if you've had the same house for 20 years and you didn't treat it like a piggy bank, and and you've treated your spouse well, so it didn't end in a divorce. You know what I mean? And you've had a business or a solid job, and you've done all that stuff. The odds are in your favor that you're going to succeed financially.
Yeah, I like that. And I like that book. So a good reference, good read. Cool. All right. So we talked about the tax benefits of owning a primary. Is there anything else before we go on to the next category?
No, that's, believe it or not, everything after this is even better. Right? It's becoming a real estate investor. The rules are better. Okay, and I'm going to push it back on you, Voltaire. There's 6 ways to make money in real estate. Bring them.
All right. You know what? I'm gonna ask the crowd.
Okay.
Type in one of the 6 ways that you can make money through real estate investing by owning one investment property. What are the 6 ways? Anybody know? Does anyone guess the first one? Okay, so we got depreciation. All right, that's it.
Okay.
That's one way. Perfect. We have rent. That's the second way. That's number 2.
Yep.
Rent growth. Okay, that's rent. That's a okay. We have appreciation. There we go. Rent appreciation or equity appreciation. You know what? I never even thought about rent appreciation. I've always just thought about equity appreciation. But maybe there's 7 ways, right? So
6 plus.
yeah,
6
6
plus.
plus. All right. So we have so far we have
Rent.
depreciation, rent.
Yep.
We have equity appreciation, normal equity appreciation. Anything else? Anyone else? We have 3 more. Okay. Principal pay down. Awesome. Okay, you got that one. That one's one that a lot of people and Jesse just illustrated beautifully how principal pay down works. Right. So okay, so we got principal pay down, rent, equity appreciation, depreciation. We have interest deductions, right? Which in there we could also put, what do you think, tax deductions too, right? Because you get to deduct the property taxes that you're paying. You're not even paying, your tenants are paying it, right? Cool. So we have interest/tax deductions, principal pay down, rent, equity appreciation, and we have inflation. Right.
Which is maybe the rental appreciation part of it, but yeah.
Yeah, I've always kind of looked at it just differently, because you have the regular appreciation over time, right? Markets appreciate.
Yeah.
And what's happening today is we're seeing just inflation. We're just seeing everything, cost of goods and services go up. They're pegging it at somewhere around, I don't even know where it's at right now, but they're saying, 5 to 10% inflation, which seems low.
Crazy. Crazy.
It is crazy what's happening. So, and with the rents, what's happening is like, I own stuff in Logan that, I was getting $1,500, $1,600, like really nice stuff. Now everything's 2,000 or over, right? And that means that if Logan and City Heights is stuff's running there for $2,000 minimum, that means the rest of the county is higher. Therefore, the average is, isn't 2,000 anymore like it was a couple of years ago. Now it's probably, closer to $2,500, $3,000. So, did we cover the 6 ways to make money? Depreciation, rent, equity appreciation, inflation, principal pay down, and then deductions, interest and property tax deductions, right? Property tax deductions.
Yeah.
So how does that work? Let's go into the tax ones are property tax and interest deductions and depreciation.
Well, Sarah, I'll give this to you.
All right.
I'll give this to you. Anybody, easy. I made this a long time ago, but it's still legit. When you look at the tax benefits of owning real estate, an owner occupant, i.e. your primary residence, you pretty much can write out the property taxes, the mortgage interest, right, up to those caps. But when you're a real estate investor, you play by better rules. You're like, what do you mean better rules? I mean better rules. When we had 2018 tax reform, there became substantially different rules based upon who you were or how you do what you do. A Schedule A we've already talked about, but a Schedule E is a completely different world. Schedule A is your itemized deductions. That's where you got your $10,000 state and local tax limit, right, on deductibility, SALT limit. You got your $750,000 interest deduction limit, right? But let's all think of a property here in San Diego. You know, if we were live in person, I'd say, oh, you know, Voltaire's building or whatever. I'm just saying some property in San Diego, right? Commercial property, and say it's $5 million, okay? You get a $5 million property, you're going to be paying substantially more than $10,000 in taxes. In fact, you're going to spend like, right? You're like $62,000 a year in taxes. And
Property
probably
taxes.
going to have,
That way
yeah,
everybody kind of understands.
yeah.
Property
Just property taxes.
Yeah.
Just on the property, right?
Yeah.
And you're going to pay interest on the loan. You know, maybe you have to put $1 million down, right? So you got $4 million at 4% or 5%. Now you got $200,000 of interest, which again is more than the interest on $750. Question is, are there limits? And the easy answer is no. There's not. Right? Why? Because if we look at who President Trump is as a person, and politically objective, apolitical, okay? Love him or hate him, don't care. But I want you to think about who he is as a person, because this is what, to understand tax reform, helps versus hurts. President Trump is married. He has children. He is a real estate investor. And he's a small business owner, right? He's a business owner. Okay. Now, the opposite of all of these positions hurts you. If you're single, you have no kids, no property, and no business, guess who pays more taxes? Right? And if you think I'm kidding, I am not. Just look at the tax brackets. For God's sake, if you're a single person and you make over $215,000, you hit the 35% tax bracket. If you're married, you don't hit that until you're 430. Twice as much. Right? So, understanding that, the difference between a Schedule A primary residence and a Schedule E rental, it's just super simple. All of these limitations are on your primary house. There are no limitations as to what you can deduct on a business, because the concept here, the idea is you're doing all of that to create a profit. And since you're doing it to create a profit, you get to write off any customary, ordinary, reasonable, or necessary expenses. So that same property, we might make, I don't know, $250,000 in rent on that $5 million property, and then we're going to be able to write off everything that goes with it. Property management and HOA fees, which aren't deductible to you personally, and mortgage interest and repairs. By the way, your sink at your house breaks, you're going to Home Depot. The sink in your rental breaks, you're going to Home Depot and getting a tax write-off, right?
Mm-hmm.
Plus,
I like that.
you know, depreciation, right? Depreciation is a wear and tear allowance. It's really easy to misunderstand it, but it's just depreciation. It's an allowance that the IRS gives you because things wear out, right? So if we go to let's just go to Voltaire, what's the address where your office is?
2802 B Street, B as in boy, San Diego.
All right. So we're just doing a Google. I didn't do this prior, right? We should be able to find it, and we might not be able to find it simply because it's a
commercial building. Yeah.
Right? But a lot of times you'll be able to go and pull up public records, right? Here, I'll just, for lack, I mean, I know my address, okay? My house, we go to realtor.com, and the public records on it are going to show what portion of my property is land and what portion is additions, okay? So you can't depreciate land, but you can depreciate improvements. So if I ever rented this out, I don't plan to, but if I did, I could take $15,900 a year of depreciation.
So what is depreciation?
It's just a wear and tear allowance.
Okay, wear and tear allowance.
But,
so if you rented it out, you would get that much on your depreciation.
Yeah.
So how does it impact your taxes?
So let's look at this. I mean, yeah, right. There's no way my house is worth $950. That's hilarious. Sorry.
Is that too low or too much or what?
Oh my God, I don't think it's double that, but yeah. Oh, that's hilarious. Okay, full story. This is the house that we moved into in '06, and it was so wonderful inside, but it was kind of janky outside, right? 2014, it burned down in a fire. It went from being 4 bedrooms, 4 bath, 3,200 feet to a 6 bedroom, 4 bath, 4,500 square foot home. With a pool on 8 acres during COVID, forget it. If my house isn't worth 1.6, I'd be like, because it sold for $995 in '06. I bought it in a short sale for $500 in 2010, and it's just been wonderful. I mean, you know, and I like living out in the middle of nowhere. See, there's absolutely no way that's true.
I'll give you $1 million right now, more than this estimate.
I'd never take it. You couldn't pay me enough. But the point of it is, yeah, that's also dumb. All right, sorry, I got squirreled there, guys. But let's actually take a look at if we were going to rent my house, and my wife's listening, we are not renting the house, right? Don't get mad at me. But you know, if you're renting a mall, what are rents right now? $3,000 a month? $4,000 a month?
I mean, you can rent a lot more than that. You know, I should go for like $5,000 easy.
So
easy.
Check it out. Let's even do that. Let's do $60,000 a year of rent, $5,000 a month, right?
Mm-hmm.
Okay. Property taxes on this, and these are just public records, and they're not perfectly perfect, but they're good enough. Okay, there's $8,300 there. Okay. So $8,300 of property tax, I don't know, our mortgage, it's crazy how low my taxes are on it, but my interest. So here we go. We got $60,000 a year of rents. We've got insurance a year of $1,200, mortgage interest of $1,200 or $12,000, taxes and depreciation. Okay, so this doesn't take into consideration all the other cool things you can do, like, you know, cleaning it, and if you have a property manager.
It's about 30% of the value that you purchased it for is for expenses. So you could just use that number, and that includes taxes and insurance.
Yeah, and what I was just looking at here, Voltaire, is if I take that 60 and I write off everything, right? My net income, right? My net income's at $22,000 a year, which means that I'm paying taxes on $1,900 worth of income, not $5,000. My tenant is paying down my mortgage while I'm benefiting from both they're paying my mortgage, they're paying my taxes. I'm getting the depreciation of the property, the increased equity every time we make a payment. Oh, and by the way, that depreciation means very specifically that 15.9, or let's say at 24%, I save $3,800 in taxes because the first $15,000 of rent is not taxable to me.
So basically what depreciation means is this number right here, whatever it is for you on your investment properties, whether it's a condo or a house or a fourplex, it means that 15,900, you don't have to pay taxes on. It's free money. So the rent that comes in, basically you just take that off right off the bat. Is that how it works?
That's just straight. It's called that. This is called in some circles phantom income. Income, because it's money you're getting that's legit tax free. It's not kind of tax free. It's just you're getting it. And like here, for example, let's say I was crazy under rent. Let's say I was getting $24,000 a year of rents. You go through all of this, and my taxable income now is $1,400. In reality, I made $24,000. I didn't pay it. I basically didn't pay any taxes on it. A lot of it because of that depreciation is just an allowance.
Got it.
Sure. Hey, Ace has a great question. So, being a real estate agent and passive activity loss limits. So to answer that question, Form 8582 is where you put in passive activity losses. And I'm not going to teach you guys how to be a tax preparer. That seems horrific. But I am going to show you that, look, what's the difference between passive and active income? Simple. It's actually really simple. Active income, earned income, is the money you make from working, right? Passive income is money you make from real estate, rents, net rental income, right? Because there's basically three types of income. There's earned, which is what? W-2 earned income or self-employed net income, right? Then you have passive, generally speaking, real estate. There's a couple of other options, but generally it's real estate. And then you've got portfolio, which is, stocks, bonds, basically bond interest and stock dividends, right?
What about real estate notes? Where does that fall?
So notes, it's weird. A note, like I'm talking, principal and interest, right? A note, that's mostly interest.
Got it. So it'd be under portfolio. Okay.
Right. It would be a secured note held by real estate, but it's taxed as interest.
Got it. Okay.
Now I'm going to put an asterisk here because it's the way it works on the tax return, but it's weird. So all right, let me explain that. So and again, Bevan, active income is earned income, your W-2 salary, your net self-employed income. Okay. If you have, and I'm going to go over a couple of easy examples here just on the fly. Okay. Let's say that you earn $100,000 a year W-2 wages. Okay. The rules are you can lose up to $25,000 a year in real estate. Okay. And then in that case, it would put you at $75,000. Okay. The real estate losses are classified as passive activity losses. Okay. Passive activity losses. Okay. A passive activity loss limitation happens if you make over $100,000, and it's completely eliminated at $150,000. Okay. Okay. So let's tease this out a little bit. If you made $100,000, $150,000 W-2, and you had $25,000 of real estate losses, I got to put brackets around that because the IRS is going to say, well, that's just too bad. You've got $150,000. Your passive losses are limited, so therefore, two things happen. Number one, your countable income is still $150,000. And number two, you've got this $25,000 accruing until you sell the property, in which that point when you sell it, you can take those losses. And I never spell accruing right for some reason. Accruing? I don't know. Whatever. But that's what it is. So now as a real estate, so passive activity limits are not necessarily based upon only your W-2. I'll pull up the 1040 from 2017 because it's actually, believe it or not, nobody believes me, but I believe this.
And Jesse, we have about 10 minutes left. I know we got to go through some stuff, but
cool, man. We'll bounce to this, but basically, your income is based upon all of your income, whether it's Social Security, unemployment, wages, whatever. It's that 150. So the bottom line here, the rules are cooler if you're self-employed as a real estate agent, because what we can do, real estate agents are considered real estate professionals, and there's no $25,000 limit, okay? More specifically, that same $150,000 a year W-2 person, okay, if they were paid $50,000 in wages and $100,000 in S-corp profits are considered passive income. Now you've got that $25,000 loss, even if you're not a real estate agent. And now that's $75,000 plus the 50. Now you're only paying taxes on 125. So the bottom line is there are cooler rules if you are either a real estate agent, real estate professional, or you have an S corporation. So back to here. Okay. Understanding the expenses and depreciation compared to a primary residence, you get to deduct more. You get to deduct not only the principal and interest, but now you get to deduct depreciation. And I'm scanning here. I can't. Here it is. Anything that you need to spend your money on to make money in that property becomes a write-off to you.
Okay, so we talked about write-offs, depreciation. Just to be clear, so you showed us your property and how much you're able to depreciate on your property, because at the time that you bought it, that's what it was worth, the land value versus the improved value. So basically, the bigger the property you own and the more properties you own that are big, that means from the bigger depreciation that you're able to take from each of those properties. Therefore, if you accumulate all, let's say you own 10 buildings, and each building you're able to depreciate, $20,000 on each building. That means 10 buildings times 20,000 per building. That's $200,000 in depreciation. So Jesse, if you make, $100,000 a year in income, does that mean that you're able to take the $200,000 of depreciation over your 10 buildings and then just offset your entire income, therefore your tax liability? Is that how it works?
Mostly.
Okay.
Mostly. I'm not, and what I should say is yes, but I'm going to say mostly, and here's why.
And the reason why I ask, reason why I ask is because I'm trying to figure out how, like you mentioned, people like Trump could make so much money, be so rich and not pay any taxes. And I'm assuming a big part of it is because of their depreciation, because he owns a bunch of hotels and apartment complexes, etc.
The problem with Trump is he's a horrible example. The reason he has all those old carryover losses, they changed the rules in the 80s on accounting. And it caused so many real estate investors back then to have horrific tax losses, right? and they just carried over. But
Got
but
it.
for regular people, you go back to that example. If you've got $200,000 of depreciation on multiple properties, the first thing we're going to have to look at is what kind of rents do you have? If you've got $100,000 of rents and you don't have any other expenses, just the $200,000 of depreciation, well then now you've got a $100,000 loss. And let's say you're a real estate professional, that $100,000 loss does offset $100,000 of income, right?
And that's
So
basically, so you could literally make $100,000 in real money, and then you could depreciate $200,000 in fake money or phantom money, and then you could walk away with $100,000 in real money in your pocket without paying any taxes if you're a real
it's
estate
crazy.
investor, or right?
Voltaire, guys, a single family residence is goofy because it's, you can do it, you can't, but you start getting multi-units, like I'm talking a 10-unit apartment, right? That's where guys are paying $5,000 to have a cost segregation analysis, because with a cost seg, instead of having depreciation over 27 and a half years, they break it down to what are the fixtures, what are the, you know, the sinks and the appliances and all these different things, because it's only the IRS has different rules for different types of the property. So I've seen guys with big commercial buildings do a cost segregation study and say, oh, we're depreciating on average $30,000 a year, but after the study's done, we're going to be able to write off $200,000 of accelerated depreciation this year, and then $15,000 a year the rest of our lives. Well, that $200,000, that comes right now, and it wipes out all their other income. That's where you do, you have a $200,000 Roth conversion that year. You let the cost segregation, the depreciation, wipe out that other income, and so now you got the tax deduction here, and it's tax-free there. These are, at the end of the day, the reason that wealthy get richer is they do two things that most people don't do, and they're two easy things. Number one, they focus on the accumulation of assets instead of liabilities, and they seek professional help. That's it. Think about that, right? How many tax and legal people do Trump have in his life? I would say quite a number, right? Yeah. And if you're accumulating, I mean, think it's all of us have the same, like, opportunities. All of us have the same motivations, but a lot of people are going to buy that new car. Oh, I need a new car. Oh, I need this. I need this. I need this. Instead of putting that same focus into becoming wealthy. And it's hard, especially because our education system doesn't teach us all this stuff. But that is the difference.
Yeah, I think as long as you're kind of know that there's ways to save money, to make money through taxes and other things, that's when you're at least aware, like, maybe I should hire a professional, a tax professional, a trust attorney, a real estate professional, a mortgage professional. You start building your team. And then once you have your team, then you get the best advice from different worlds. So I appreciate that. Is there anything else that we missed before we call this meeting to an end as far as tax savings? We talked about, the standard deduction. We talked about the interest deduction on your personal residence. And then we talked about deducting on your investment real estate taxes, interest deductions with no limits, right? And then we talked about depreciation and how you could just start accumulating depreciation for multiple properties and, offset your actual income tax. Anything else that we missed?
No, I'm just going to say real estate investors have cooler rules than homeowners. Mm-hmm. But you got to get in the game, right? Most people, it's easier to buy your first property, right? It's easier to buy your first home because you get primary, owner-occupied financing on it. You buy a duplex or a fourplex, with 3.5% down, that's a lot easier than 30% down,
Mm-hmm.
right? And you're probably not going to live there your whole life. So you got to get in the game somehow.
Yeah, and by the way, we have other workshops where we talk about how to get in the game. You buy your first home to live in, you move out after a few years, you turn that one into your investment property, and then
Yep.
you get primary residence financing again, like first time buyer financing all over again to buy your
Yeah.
second home, right? And then after a few years, you move out of your second home, you keep that one, and then you move into your third home again with primary residence financing again. Now you have 3 properties: one you live in, 2 that you rent out, and then you just keep accumulating. So a lot of my clients that have a lot of wealth, and by the way, the largest client that we have has a portfolio of $1.2 billion. And then and then from there we have, you know, a couple that are in the hundreds of millions, and then a bunch of the tens of millions of dollars, and a bunch of you know, people that only own 1 property or 2. So but they all have a similar story where they all kind of started with their first home that they lived in, whether it's a condo or a house, and they just kept moving up, making moves. And like Jesse said, you have to be in the game in order to be able to shoot the ball, right? You just can't just be on the bench watching. So appreciate your time, Jesse. If you guys have any questions, reach out to us. If you have any questions about your taxes, you know, how you could get some of these benefits if you own investment properties, and how to file your taxes, because a lot of you, if you have H&R Block and others that aren't used to this type of stuff, you might be missing some of these deductions. Reach out to Jesse. You know, he helps me with my stuff, and he could help you with your stuff too. So I appreciate you, Jesse, for jumping on. If you need his information, reach out to us, send us an email or a text, and then you can type in your info right now, Jesse. Before we call it.
Just roadmaptax.com, man. Boom, go there, send an email to, you know, Rachel. She'll get you on the calendar. It's crazy. 10 years ago, I was a one-man band, and I got to have a team. And it's cool, but it's, wow, you know?
Yeah, congrats. And then the other thing is we have these workshops twice a month, different topics. The next one's going to be a VA workshop, which Jesse's VA, right, Jesse?
Oh yeah.
And so you could definitely
make it sick to know my rate.
2.5.
2.25.
2.25.
But when this craziness went, check this out. I had 3.25 for 15. I refinanced it to 2.75 for 30. It freed up $2,000 a month of cash flow. I put all of that in my 401k. So not only did I use that cash flow to save me some crazy amount of money in taxes, plus accumulate wealth simultaneously. And then because it's an IRRRL loan, the interest rate reduction, just my broker called me up and said, "Hey man, you got 2.75, we get you 2.25." Okay.
Yeah, that's a no-brainer. So, and that's all about, that's what we're about, accumulating wealth. And then, so we had the VA workshop, and then now we have on the 26th of April, we have the ADU workshop. By the way, real quick plug on the ADU workshop on the 26th at 6:30 to Tuesday. I think that's a new gold rush. That's the way that like me growing up in real estate, I was like, man, I wish it was the 70s again, you know, and because, you know, I have a bunch of clients that were telling me, oh yeah, I bought this property in the 70s, a 3-bedroom, 2-bath house for $20,000. I'm like, what? How much? And that was the gold rush back then in California. It was people buying real estate and accumulating. And back then you could do like, you know, seller carrybacks and all kinds of like cool financing that doesn't necessarily exist anymore too often. But this is the time that I think a lot of us, I've been waiting for, is ADUs, okay, accessory dwelling units. On average, I think I did the math. Once you finance it, you're netting after all expenses $900 per ADU that you create. So if you have a garage, if you have, you know, a house that you could build something on with some land, you could take advantage, make about $900 on average net. And well, that was with the financing maybe a couple months ago when it was a little bit less. So let's say it's $750 net. That's still net income. So if you learn these rules from the guys that are going to jump on and kind of teach us, and they're always evolving, these rules, by the way, they're getting crazier just because California needs housing. San Diego needs housing. We're negative 30,000 housing units. So the government will tell you what you need to do to make money. So they're incentivizing homeowners to develop ADUs, and the benefits are so great that you can make a lot of money. Okay, so we have to pay attention to these laws. So those are the next 2 workshops. If you want to join those workshops or just get our monthly newsletter that invites you to the workshops and other stuff that we have going on, just shoot us a message with your email, and then we'll add you to our email list. Thanks a lot, Jesse. And thank you all for jumping on and learning about taxes on a Thursday night. We'll see each other.
All right, take care now.
All right. See ya. Peace. Thanks. Thank you all. All right. Let me jump off of Facebook here. And it's a wrap.